Welcome to Earnings Intelligence. Today we're jumping in the time machine and going back to the first quarter of 1997. Why? Because Berkshire Hathaway released a report that, on the surface, looked like an absolute catastrophe. We're going to unpack those numbers and show you why that headline-grabbing disaster wasn't the real story at all.
All right, let's get right into it. When these results first dropped, if you were just a casual observer reading the headlines, you would have thought something was going terribly, terribly wrong at one of the world's most admired companies.
And this was the number that grabbed all the attention. A drop of 83% in net earnings compared to the year before. I mean, for a company like Berkshire Hathaway, a number like that isn't just a red flag, it's like a five-alarm fire.
And when you look at it on a per-share basis, the story looks just as grim. Earnings per share, or EPS, fell off a cliff, going from nearly $1,400 all the way down to just $231. On paper, this looks like a total train wreck.
So this forces us to ask the big question, right? Was Warren Buffett's empire actually grumbling? Was the magic gone? Or was there something else going on under the hood that the headlines were missing? Well, let's find out.
So here's where we need to put on our detective hats. The key, as always, is to look past those big, scary headline numbers and find out what's really going on. Let's decode what these earnings figures are really telling us about the health of the business.
And to solve this whole mystery, you really only need to understand one key term: realized investment gain. Just think of it like this. Say you sell a house you've owned for 20 years. You probably made a huge profit, right? But that's a one-time thing. It's not your regular day-to-day salary, and it doesn't really tell you anything about your financial health for next year. And boom, here's the answer. That huge profit number from 1996 was massively pumped up by a single event. Disney bought a company called Capital Cities/ABC, which Berkshire owned a huge chunk of. This created a gigantic one-time gain of $2.2 billion. It was like they sold that 20-year-old house.
And this slide right here tells the whole story. You've got two completely different narratives. On the left, you have the reported earnings with that big one-time gain, showing that scary 83% drop. But on the right, when you strip that out and look only at the operational earnings, the profits from their actual day-to-day businesses, the story completely flips. The company wasn't shrinking, it was actually growing at an amazing 64% clip.
So, if the real business was thriving, where was all that growth coming from? Let's take a look under the hood at the company's main growth engines. Now, the heart and soul of Berkshire Hathaway has always been its insurance group. This is their cash machine. And back in '97, the absolute star of the show was GEICO. For any insurance business, a key number to watch is the underwriting gain. That basically tells you if they're making a profit on the policies themselves before they even invest the money.
And the signs of health were everywhere. This first number shows you the growth in GEICO's policies in force over the last year. In simple terms, their customer base was growing at a very, very healthy rate of almost 13%.
But hold on, check this out. This is the real jaw-dropper. New business sales at GEICO shot up by over 70% compared to the same quarter last year. This wasn't just steady growth, this was explosive. It was proof that GEICO's business model was really starting to hit its stride.
And the good news wasn't just coming from the insurance side. Berkshire's other businesses, and we're talking about a whole mix of things from candy to furniture to encyclopedias, they were also doing great. A big part of that was thanks to a new company they just bought called FlightSafety International.
And you can see the impact right here. Net earnings from this whole group of businesses jumped by 54%. The report specifically mentions that flight safety was a big contributor, but also that sales at See's Candies got a nice little boost because Easter fell earlier that year. Little details matter.
Okay, so the operating businesses were firing on all cylinders. But that's only one half of the Berkshire story. The other, equally important half, is its giant fortress of an investment portfolio.
And this gives you a fantastic snapshot of their whole philosophy. They weren't trying to own a tiny piece of hundreds of companies. No, they made huge concentrated bets on a few world-class businesses they understood deeply. You can see here that Coca-Cola, Gillette, and American Express made up over 60% of their entire stock portfolio. And this really shows you the power of their patient, long-term approach. Look at this. Over the years, Berkshire had paid about $9 billion for all the stocks they owned. But by the end of this quarter, that same portfolio was worth over $28 billion. That nearly $20 billion difference is what we call unrealized gain. It's pure value created for shareholders just by picking great companies and then sitting on their hands.
So when you put all these different pieces together, the confusing headlines, the strong day-to-day business, that massive investment portfolio, you really start to see a clear, consistent philosophy emerge. It's what we call the Berkshire Way.
And hey, you don't have to take my word for it. This is basically pulled right from the report itself. Management is literally telling investors, hey, you, stop looking at that headline number. It's useless. They're saying that these one-time gains don't predict anything about the future and have no real value for analyzing the business.
So, if Berkshire is telling us to ignore that headline number, what do they want us to focus on? This, book value per share. The simplest way to think about book value is if you sold everything the company owns and paid off all its debts, what's left over for the shareholders? Well, in the 12 months leading up to this report, that value had grown by a fantastic 29.3%. That, they say, is the real score.
So after digging through all of this, what's the big lesson? What's the main takeaway from this really fascinating report from way back in 1997?
Well, this report basically gives us a playbook for how to read any company's financial statements. Step 1, always question the headline. Step 2, dig deeper and find the real operational earnings by taking out any weird one-time events. Step 3, look at how the individual parts of the business are doing. And finally, Step 4, check the real measures of long-term value, like book value growth.
And ultimately, this whole exercise leaves us with one big, important question to think about. Where does a company's true health really come from? Is it in the noisy, up-and-down quarterly profit that everyone talks about? Or is it in the quiet, steady, long-term strength of its actual businesses? I think Berkshire Hathaway's 1997 report gives us a pretty powerful answer.